Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. So, in September, October and November last year, a few bullish patterns started to emerge. The mid-September 2023 action eventually became a pattern, an ascending scallop pattern, that led to another pattern, an early October to mid-November 2023 bullish halfway hesitation, which in turn led to the late October 2023 to early February 2024 imperfect, breached, now broken bull channel. I previously suspected that the breaking of this bull channel was due to the crossover 13 weeks ago of the upper bull channel line with the significant neckline currently at 185.55 of the large January 2020 to April 2021 reverse head and shoulders bottom. That's the one highlighted in green on my daily chart. The break higher over the upper bull channel line eventually led to a move up towards the combined resistance in mid-December last year of November 2014 high at 201.35 and the 50% Fibonacci line of the February 2022 to January 2023 move at 201.70. Though I suppose you could also throw in the bright red declining neckline currently at 201.40 of the April to May 2022 reverse head and shoulders pattern. Between them all, the market's rise was halted and turned back down through the bull channel for the first time and eventually stopped down at the combination of the 50% Fibonacci line. So the May 2019 to February 2022 move at 174 even. And the August 2021 low at 174.5. In the middle of January this happening. We've since moved back up during late January and mid-February over the congestion between 187.40 to 187 even and the broken lower bull channel line. But 5 Fridays ago we saw a bearish engulfing pattern that closed below the broken lower trend line. And despite attempts to push back up into the bull channel, the market gave up trying 3 weeks ago and headed lower. Below the green neckline, below the 2016 high at 179.55, and all the way down to test the important 50% Fibonacci line of the June 2020 to February 2022 move at 177.45, which has the rising medium moving average currently at 178.35 acting as a backup. All this action allowed me last week to draw a dark blue December 2023 to February 2024 bearish Andrews pitchfork. The market is currently testing the upper tie above, currently at 185.55, which is coincident with the green neckline. It actually punched right through it. And the short moving, medium moving average as well. So it's punched through all three of those things today at the moment. Now, I am not in love with this pitchfork, not yet at least. So I would happily retire and draw a fresh bearish shift pitchfork, a shallower one, for the same move if it turns out to be better, which it may do. So I'd just like to watch a few things first that might indicate such a move is in the offing. Firstly, that rising medium moving average may temper any bearishness. That's below. It's not highlighted, but it's below, and is the one to watch for the next few weeks. Secondly, still keep an eye on the previously tested and still holding strong support of the purple colored, well, strong-ish. It's held until today. Keep an eye on that purple colored 50% Fibonacci line below of the May 2019 to February 2022 move, still held there at 174. This is a key level to watch on the downside, especially on any significant confirmed break below it, and even more so if thirdly prices break down through the flatlining long moving average below, which is currently 170.10. Now, importantly, on the top side, well, I've already detailed the top side resistances, but just to recap, the green neckline, the short medium moving average, also in green. The 2015 high at 187.80. And for a lack of a distinct topside, I'd add the lesser 38.2% Fibonacci line of the May 2019 to February 2022 move at 194.40. These are being attacked now. Maybe not the last one, but the others have been, with today's break high, and I doubt if all the resistances will actually survive this upward pressure. London coffee. The influential pattern here from the middle of 2023 until really November to December 2023 was the June to December 2023 bear channel. Attempts to break out, up and out of this pattern happened as far back as late October 2023, but really pushed higher happened in mid-November last year, with the market utilizing, to varying degrees, the rising short medium moving average, currently 30.44, the long moving average, currently 26.47, and especially the medium moving average, currently at 27.85. During the process of breaking higher, the market also formed a small October to December 2023 ascending triangle, breaking higher out of this pattern at the start of December 2023, somewhat violently. The jump up reached the primary target and eventually the secondary target topside for this ascending triangle pattern. Then there was the second larger pattern, the original broken bear channel. Both the primary and secondary targets for the bear channel were also reached topside, was making new all-time highs at its time. Now, 12 weeks ago, I laid out the following ideas topside, and I quote, "When I do look higher, I can see a projected 50% Fibonacci line at 30.83, which may be a little rich for some in the market," end of quote. Well, apparently this was not too rich, as after a pullback down in the end of December last year, which turned out to be a bullish halfway hesitation, well, 7 weeks ago, prices reached up and punched through the 50% projected Fibonacci line at 30.83. However, though we have seen prices move significantly higher since, the market in fact has ended up stabilizing right on this 50% projected Fibonacci line, before last week properly punching down through it. But only as far as the next 50% Fibonacci line below, the one from the whole of 2024 so far at 30.02. This 50% Fibonacci line was reinforced by the rising short medium moving average, currently 30.44, and a very recent 50% Fibonacci line at 30.02. Enough that we saw prices rise significantly last week and now this week so far. All the action since late January allowed me last week to draw a small bearish channel come declining expanding wedge pattern, currently 29.85 to 32.14. As I said last week, and I quote, "It is still fairly early on in its life, but it has 4 touches so far, and I'm interested to see if the 3,000 level will hold. And we see a possible 5th touch. So keep your eyes on the pattern and on the 250% Fibonacci lines at 30.02 and 30.83, end of quote. I really needn't have worried about the supports below, because it is the upper bear channel line that has been tested today and raised the question as to whether the action since mid-January is really a topping action, or is it instead a possible bullish halfway hesitation. Now, I don't have an answer just yet, but with the 2024 all-time high at 32.62 now under threat, it is a question that needs asking. I hope we have some answers by next week.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.